Hello, everyone, and thank you for joining me on Jane's February 2024 retirement account review. Sorry for all the delays lately. In addition to having recently lost my grandfather, my dog was recently diagnosed with an aggressive bone cancer and probably only has a few months, maybe a year to live. Anyway, just been making it a point to really spend time with him and go for hikes and do things. And then in addition to having a newborn, just been a lot on my plate lately. So anyway, yeah, let's go through our numbers here. I've been spending some time here getting caught up recently, and yeah, this should be a pretty interesting review. I will mention that I did see some comments on the previous video talking about how I choose stocks to follow or choose stocks to invest in, and that's something that actually I will make some videos on, maybe even some individual ones. I'm trying to look for ways to make content that isn't so time intensive in terms of the manual work before and then shooting the video. So I think there's some good ways that I can show those things. So anyway, thank you for putting that in the comments, and I will make sure to hopefully make something soon. So, I'm not a financial advisor, don't claim to be one, and this video does not reflect the views or opinions of my employer. I do share a number of positions in common with Jane, and I have those listed on the screen. It's an actual portfolio with real shares being traded, and that is why I provide so many screenshots in order to demonstrate that this is real money being used in a real portfolio. So for John and Jane, and again, my goal is to make it so that I can have these videos where this is no longer a component of it. That can be its own separate video. But anyway, John and Jane, were being taken advantage of by their financial advisor. Basically, our relationship goes back quite a few years, and it just came down to how about you guys manage it, on your own? I'll assist you with it. And then I just ask that they allow me to publish the results so that other people can see that it's possible, and, hopefully give them confidence that they can do things for themselves. So for the background, John and Jane are both retired. Both are collecting Social Security. In addition to that, they currently draw $1,700 a month from the taxable portfolio, and right now it says $1,000 a month from John's portfolio, his traditional IRA. I haven't updated that. I believe it's closer to $1,200 a month, and you can see those in the other videos that I do. I'll make sure to update this for next time. They do have investments outside of what I help them with, and that's mostly low risk investments at other financial institutions. And then John and Jane have no debt or monthly payments, so it does make my job very easy. So on the headlines here, traditional IRA generated just under $1,400 of income in February of 2024, and that compares with just over $1,100 of income in February of 2023. Roth IRA generated just over $960 of income in February of 2024, and that is compared to just over $740 of income in February of 2023. So great results in both of these. I will go into a little bit more context here because those do look like substantial jumps in income, especially for the month of February, which is not usually a very high paying dividend month. So for the traditional IRA, the balance is just over $450,000, and that's compared with just over $427,000 in February of 2023. Roth IRA remains about flat year over year with a balance of $206,000. That compares with a balance of $204,000 in February of 2023. So 3 companies in Jane's portfolio paid increased dividends or a special dividend during the month of February, and no companies decreased their dividend during the month of February. So for the dividend increases, we have an 11.1% increase by Archer Daniels Midland from 42 cents a quarter to 50 cents a quarter. AMT, which is American Tower Corporation, that was a 4.9% increase to $1.70 a share from $1.62 the quarter previous. And then RY is the Royal Bank of Canada, and that is 2.2% increase. And I do have that noted in Canadian currency, since obviously that one fluctuates when it converts to US currency. So for Archer Daniels Midland, on here, Jane's collected a total of $680.50 since June of 2020. After the increase, the position is set to produce $100 of income annually. That is going to look really low when you think about it compared to how much she's collected in total. And the big reason for that was in 2022, we had sold off 100 shares when Archer Daniel Midland was really at a high point, especially compared to its current price now. So the position was cut by 66%, and that helps explain part of the reason why income has been reduced so much. And then for AMT, Jane's collected a total of $854.15 since April of 2021 when the position was established. And then after the increase, the current position is set to produce $442 of income annually. So as you can see here, that's substantially more. If you take the timeline or the dates and you look at it, it was producing even more income, but we actually recently sold the higher cost shares, and that's part of the reason why you don't see the original shares that were allowing the dividend to be accrued in April of 2021. You don't see the cost basis for anything before 2022, and a lot of that was because that was a cost basis that was going to be over $200 a share, and that's what we've been trimming back as time goes on. So there's been a lot of trades going out of this account or out of this stock, and again, the big thing's just been to sell it when it's getting over the $200 share range, and then buying when it drops below 190 is pretty common as far as the strategy goes. And then for Royal Bank of Canada, very similar situation here. In the sense that it's produced a lot of dividends, but we reduced the income from the number of shares from 65 to 15 shares, and that's part of the reason why it's not producing nearly as much income as it was before. We have very low cost basis here, whereas the 50 shares that were sold were definitely on the higher end of the cost basis, and that was part of the reason why we cut them. Also, for anyone who's watched these videos, you'll know that I have had some issues with the Canadian banks, and there's some exposure with them to their real estate market that's a little bit concerning to me. So anyway, it was just one where I think Royal Bank of Canada is great. I think that it's probably one of the better financial institutions in Canada, but it was something where I was happy to cut those shares. Simply because I thought that the higher cost shares just weren't worth holding any longer. So for February in the traditional IRA, there was a handful of trades that were made, most of which were purchases, with the one sell being for LyondellBasell. And you can see that was trimming back a pretty large portion of that position. And then for the February trades for the Roth IRA, we had 2 sells and then 3 buys. And the big story here is going to be for New York Community Bank Corp. And we're, I don't want to say lucky we sold out when we did, but also this was originally a 600 share position. We had trimmed it back when shares were kind of at a high point, and then sold off the rest of the position here. Normally, I am not one for a knee-jerk type reaction selling, but on this one, after reading the report for New York Community Bank Corp on their earnings, it was pretty clear to me that it was something that we wanted to stay away from altogether. Even with the stock price being now closing in on almost half the price that we had sold it at, I still, for John and Jane, it does not make sense to hold them, just because the real estate exposure on the commercial side is just, it's something that's going to plague that bank for years as far as I'm concerned. So for the February traditional realized gain loss, here we had originally set a limit trade for Lyondell Basel, and we had actually canceled it and then just chose to sell these off earlier. We could have stood to, come a little bit closer to a break even had we held on a little bit longer, but hindsight's 2020 on that. And really with this was the last remaining high cost shares for Lyondell Basel. So the cost basis of that position is now considerably lower, because we've accrued shares anywhere between the low 90s all the way down to the high 70s. So that part is the reason, part of the reason why. And because with the sale of these shares, this covered all the purchases that were made. So in the traditional IRA, basically what we were doing is we took this capital, reallocated it to other things that were undervalued, and so it's there was reason to why we pulled that trigger a little bit sooner, because it just made sense at the time, especially because when you look at the other stocks that were purchased, like Enbridge and these other ones, they were purchased at opportune times, where now that stock price has moved higher as well. So we bought at great entry points on a lot of those. And then for the Roth IRA, again, big story going to be New York Community Bank Corp. And on this one, so even though we sold off before, as soon as the bad news hit, it still, wasn't soon enough to avoid some of these losses. So it was still a pretty substantial loss on that one. And again, I do not regret selling it off, and we have zero interest in getting involved again with New York Community Bank Corp. And that is a great example of one where we paid close attention, but apparently a lot of people missed the mark on that one, and I take the blame on it. That ended up not being a great investment choice. And then if you look at the year to date here, you can see that basically both accounts in terms of gain loss are sitting in the negative. One of the things here is that typically with the IRAs, it does not matter because of the fact that it doesn't actually count until the money is drawn. But typically I do like these to be positive, and the main reason why is because if there's a bunch of negatives here, then it's part of what makes it look like that the portfolio is doing better now that we sold off, like this one with New York Community Bank Corp. You could hypothetically sell off your losers and make it look like the existing portfolio is just absolutely crushing it. So the thing is that I just don't like to have too many losses on here, because it gives a more complete picture of the story of, oh, the Roth IRA is doing well, but it's if you start having too many losses showing up on here, then you go, well, is the Roth IRA really doing that well? And that's also part of the reason why when we do the sells, we're typically taking smaller losses, like when we did the Lyondell Basel, and we had $220 worth of losses. No big deal. That's not a huge thing. But on the sale of the New York Community Bank Corp, that was like a 33% loss when you take into account the size of that position. So if you guys have more questions on it, you can let me know, and I'll try and explain it a little bit more clearly. But really, again, it's just about showing the full picture, and you just don't want to have someone saying, look at how great my portfolio is doing, but yet having tons of realized losses, because that's a little bit deceptive. So for the February year-over-year comparison, the biggest difference here that I wanted to point out, and I'll kind of elaborate more on this at the end, is that the traditional IRA in particular is generating a lot of income currently from the money market and then from the CDs that John and Jane are invested into. Now, that's important to note because this is largely going to be monthly income in comparison to equities which are being paid quarterly. And I mentioned before that February is not traditionally a strong month for dividends in terms of it being when a company is paying out. So the thing is that by adding these here, this is going to be $400 that's going to be pretty common and recurrent over the upcoming months. We're taking away from some other months that maybe we haven't reported on yet. And now that income is being reported in February. So we'll see that as time goes on, whether or not the substantial increase here was because we maybe shifted to investments that were paying in the month of February or paying monthly, like in this example, as compared to say an investment that did not like an investment that was maybe previous held, like a different stock that was held, that maybe didn't pay in the month of February. So it's a timing thing. And an example of that too might be like when you look at Archer Daniels Midland here, well, February of 2023, they didn't pay in the month of February. I believe they paid in the month of March. But in 2024, they did pay in the month of February. So timing is really what it boils down to. And then for the Roth IRA, very similar situation here when we add in the money market and then the CD income. Although I will note that, the size of the increase in the position of RNP, which does pay monthly, and then also, wasn't Main Street, but with ADC, which also pays monthly, those were two big factors that added to the income here, more than just the money markets and the CD income. So for the full year comparison, and remember these numbers that you see on here, these are the least optimistic scenario possible. This is basically taking the worst situation, no dividend increases, no collecting of interest income, and that's part of the reason why the traditional IRA is being hit harder than the Roth IRA is because the traditional IRA is more dependent on money market and CD income than the Roth IRA is. But for the month of February with the updated numbers, it's tracking a negative 18.9% income growth, but that compares to negative 21% in January. So that's a 2.1% increase in 1 month. Estimated 0.8% growth in the Roth IRA dividends, and that compares with 0.5% in January. So that's a 0.3% increase. Traditional IRA income increased by 25.76%, and then the Roth IRA income increased by 29.8% compared to the same month in the year previous. And for the account balances here, they're up modestly in the traditional IRA and then basically flat in the Roth IRA. I do like seeing here that when we're looking at the average balance year over year, we're looking that we're off to a real strong start in the traditional IRA, and then it's still a pretty strong start here, considering that the balances in the Roth IRA were actually in some cases substantially lower than where they are here. So no withdrawals have been made. All dividends and interest are collected as cash. And then for the 7-year traditional IRA income comparison, Jane's managed to grow the income produced by this portfolio by at least 10% every year for the last 5 years. Obviously, right now it's projecting that it won't be, but again, this is the very negative or the non-optimistic point of view. I do have some slides coming up that go over a more realistic scenario in terms of expectations. And then for the Roth income comparison, you can see here that we started off with the baseline of 0.8. Well, technically we started off the baseline of 0.5. It's now at 0.8. And with the exception of 2020 with COVID, the Roth IRA has also seen a pretty substantial increase in the dividend and interest income. And then for the cash balances here, you can see that cash balances have been drawn down in the Roth IRA. They were sitting a little bit higher in the traditional IRA, but it's, I think, important to remember that anything that's in CDs is not included here, and money markets. So as of right now, there's $120,000 in the traditional IRA. So this 26,000 number and 38,000 number is a little bit higher because maybe a CD expired before the end of the month. So again, a timing thing. So these numbers I expect will come down in terms of the cash on hand, because the amount of money that is invested into CDs and money markets in both of these accounts combined is $150,000. So it's a pretty substantial amount of money. And then for the unrealized gains, you can see here where the unrealized gains are continuing to go up. But it's still less than it was in 2023. Now, the interesting part when you start to think about it is that this same time frame in February of 2023, the balance in the traditional IRA was, I believe it was about $23,000 less. And so this is why it's important when I was talking about the unrealized or the realized gain loss screen, is that if high unrealized gains don't always translate into higher account balances. So this may have been a scenario where we sold off some of the higher unrealized gains to then realize those gains and then use those funds to invest in like CDs, money market. That's where most of that money came from. But now in 2024, we're still sitting on gains, but the gains aren't nearly as much, even though the account balances are $23,000 higher than where it was the same time in 2023. So again, kind of an interesting distinction to note, because I think it's possible that people will look at these unrealized gains and use that as a way to say, oh, my portfolio is performing well. Well, it just depends on what you do with it. And when you have a CD or a money market, there really isn't going to be any unrealized gains with it. You know, if you buy a CD at a great rate and then all of a sudden rates start dropping, you know, maybe it's worth a premium, but still it's just not the same. It doesn't work the same way as a traditional equity stock does. So for the traditional IRA, you guys saw this on the previous the previous video. You know, we have the percentage of account total dividend, but also the percentage of income that comes from that specific investment. So like a good example here would be that, you know, 5% of the account is Enbridge and it produces 8% of all the income. So that's just kind of an example of how this table works. And then on it, this table was updated for March 22nd, so this is going to be extremely accurate, at least as of the time that I published this video. And as of right now, you have 3M, Crown Castle, and then Lumen as the most underwater positions, which is represented in this gain-loss column here. And then you have Broadcom, Eaton, and then Iron Mountain represent the highest potential for capital gains. And then for the Roth IRA, same exact thing here in terms of how it's set up. And one of the things I will note is that we did recently add to ADC. This is a good example where ADC, Agree Realty, makes up a pretty substantial amount of the account. One, remember that the Roth IRA is about half the size of the traditional IRA, but also this is saying that, you know, over 10% of all the income is for Agree Realty. So the thing is that we're actually at a full position with Agree Realty at this point in time, and we would want to see the market value on the stock price increase, so that maybe we can start selling off some of the higher cost shares. Because really at this point we can't justify putting more into it, just from a portfolio balance and where the income is being generated from perspective. So anyway, this is also updated on March 22nd. Agree Realty and then Altria represent the most underwater positions, and then Bank of America and Main Street Capital represent the highest potential for capital gains. So for the traditional IRA income forecast, this is the more realistic expectation, and also breaks down the categories where the income is being generated at. And what I mean by that is that I want to know how much dividend income is coming in, and then how much interest income is coming in. Specifically with interest income, I'm really focusing on CDs and money markets. So just to give an example, in case this is your first time watching this video, what we're saying is in 2023, this portfolio for the traditional IRA generated $1,105.61. In 2024, $968.33 came from equities. So these are going to be stocks, can be preferred shares, anything that isn't what we would call like a true stable fixed income instrument. I know you can make the argument with preferred shares, but they're not, in my personal opinion at least. In the column for 2024 with CDs here, this is going to look at CDs and money markets and say how much income was derived from that source. Part of the reason why I want these separated is that this section here is going to be subject to potential dividend increases by the company, raising the dividend. Whereas when you have a CD or a money market, the money market interest rate can change, but it's never like you're getting a increase on your certificate of deposit in terms of the rate that they're giving you, maybe unless you have a bump or something like that, but those are pretty uncommon nowadays. And so I wanted to know how much of this is subject to potential increases versus how much of this is just going to be straight across the board until that investment expires, or until you take the money out of it, like a money market, or if the rate with the money market drops. So then we get both of these add up together to get our total income here. And then these columns here really are representing kind of like a placeholder to say how much income would have needed to be generated in order to have achieved a 3%, 5%, or a 7% increase. And in this case, that's why we have a 25.76% increase, because that's how much it went from 2023 February's income of $1,105.61 to $1,390.41 in February of 2024. Now, on each of these months, we track these individually. Part of the reason why is because we want to know where the income was increasing at. But also down here at the bottom, you can see where the projection here, instead of being, 18.9% negative, for the year, this is estimating 0.5% of growth. And that's assuming that all these numbers remain the same. So if we continue to outperform, we'll continue to see this number go up. But if we see this fall back, we'll see this number drop. But as of right now, we're looking at basically a 0.5% increase in the amount of income generated in the traditional IRA as compared to the income produced in all of 2023. And that's really what this table is intended for. Now for the Roth IRA, same exact thing. You can see the increases are larger in terms of what we're seeing here, but also instead of the scenario where we're looking at 0.8% income growth year over year, we're now estimating on here 13.7%. But I will say that when I looked at the previous month, I want to say it was 14, like mid 14%. Increase in income year over year. So it did drop. So even though this number is higher than what we had in 2023 here, this number is lower than the number that we had originally estimated that would have came in. So yes, still results in a gain, just not as much of a gain as what we thought we were going to see. So on the conclusion here, Jane's portfolio produced a combined income of $2,352.13 in the month of February 2024, and that compares with $1,846.54 in February of 2023. No funds have been added to Jane's account in the last year, so this growth has largely come from using the additional income to purchase stocks. The other thing that plays into this as well is selling off shares that were performing really well that maybe had low dividend yields with them, and then using those funds to purchase certificates of deposit that were producing maybe double, triple the yield. So basically, going from high value stocks, low dividend yields, to now certificates of deposit, which aren't going to produce a high value in terms of no capital appreciation, but produce a higher dividend, or interest income. So another thing too is that, and I mentioned this previously, is that how much of Jane's portfolio has been shifted to fixed income sources that typically pay monthly compared to equities that typically pay quarterly is something that I think that will kind of play out over the next couple of months, and give more perspective about where things actually are with that. And so if in fact it is a major factor, we'll end up seeing the estimated income on the more realistic expectations, the last two slides, see those come down, maybe even on the traditional IRA get into the negative, or we'll end up seeing that it didn't play a major factor. So anyway, that'll be an interesting trend for us to kind of monitor and understand, in terms of it's not like they got substantial dividend increases for the month of February that added up to that 29%, because you could see the investments that did give raises, and none of them would have come close to offering that kind of sizable income increase. So anyway, thanks everyone for watching. Hope you're finding these videos helpful. Sorry again if I'm rambling, or if maybe my thoughts aren't as cohesive as they normally are. I just have a lot of things on my mind. But again, I do appreciate the feedback on the comments, and I'll look to make maybe a couple videos, especially because with Jane, we did recently add CME, which stands for Chicago Mercantile Exchange. We did add that to Jane's Roth IRA. And so that's something that is going to be discussed a little bit in my Seeking Alpha article that I wrote for John and Jane. But that's something I could easily make a video on, that would be just a few minutes long to kind of go into some of the whys behind it. So anyway, thanks everyone. Appreciate it, and have a great day.